Are you ready to try your hand at placing your very first stock trade? Then check out our free guide, 10 Steps to Choosing Your First Stock to Trade, the Ultimate Beginner's Guide. In this free download, you'll learn how to choose the right kinds of stocks and how to find them, know when to buy your stocks and when to sell them, and you'll learn how to take your very first steps to becoming a stock trader and much more. Grab your free guide now by going to TRADEway.com/guide. That's TRADEway.com/guide. Hey guys, I'm David Mitchell, founder and CEO of TRADEway. What if God himself gave you a blueprint for how to handle your money? Well, the Bible is a practical book. Let's dive in and see what it has to say about wealth, about risk, about leverage, and about investing, and uncover how trading in the stock market can be a powerful tool for moving towards your biggest goals. We're so happy you're here. This is The Word on Investing. Hey guys, welcome to the podcast. Well, last time we talked about how to know when to actually place a trade. Today I'm going to continue with that theme. Now remember, each pattern has its own perfect buy and sell point, and the buy points are actually the easiest, and that's what we're talking about. We might take another time to discuss sell points. It's a little more difficult with some of these, but the buy points are kind of easy, and yet they're so important. If you don't get the perfect buy point, it really hurts your ability to make money over a long period of time. You'll even think you're not a good trader at all, and it could be just because you're cheating on that one rule. You're not waiting for the perfect buy points, or you're settling for one that's gone a little bit too long, too many days into its pattern, and it's already up in the middle of the range, and you say, well, it's still going to go up another few points, I'm going to buy it. That's cheating. Don't do that. You need to get the perfect buy point. So developing the discipline to make yourself only get in trades that are at the perfect buy point for these patterns is hugely, hugely important for your success. And most people miss it. So you might want to re-listen to this about once a year because it can really mess up your trading if you don't get this point right. And yet it's so easy to do. It's a matter of controlling your emotions, actually, because what happens is you wake up one day and you see a perfect pattern, but you should have seen it 3 days ago because it's already moved up and it's past the perfect buy point. And you say, well, it's still so pretty, I'm going to jump in there. That's just a lack of character because you had a rule that said don't do that and you just broke the rule. You see, you did it because your emotions said, oh, but I'm greedy, I need to make this money. That's really what happened, but we don't think of ourselves as greedy, do we? But anyway, we have to learn to control those. How do we do it? With rules. Here's the rule. Only get in at perfect buy points, okay? I hope you got that. So in order to know when to actually place a trade, you got about 3 steps. I'll review that from last time. First, you got to memorize the best recognizable patterns that stocks make. And when you go out to TRADEway.com, any of those educational packages we have, they're going to teach you those patterns and how to know the perfect buy points. So go check that out at TRADEway.com. You need the education and you need the practice and you need to do the paper trading and the small money trading and all the things we teach you how to do. You need those skill sets before you try this. So please do it. Now, you're going to learn these awesome patterns and the perfect buy points for each pattern. Secondly, you need to know when the market tone is right for the particular trade. And we talked about that in the last episode. You can go back and listen to that. Thirdly, you need to know the stock has great fundamentals. It gives it a reason to go up if you're doing an up play, or you might want bad fundamentals if you're buying puts, right? So we talked about that a little last time too. Today, I just want to continue to focus on the perfect buy points for these patterns. Well, last time we talked about the basic patterns, the rolling stock pattern, the uptrending pattern, the downtrending pattern, the cup and handle, and the saucer and handles. And those are really some of my favorite, not so much the saucer and handle, but the other 3, the downtrend, the uptrend, the rolling stock, man, those are powerful. And the most of all, in a bull market, especially the first 1 or 2 or 3 years of a new bull market, the cup and handle is the most powerful. So go back and review the last episode if you didn't catch that, because that's a great one. Now, I want to talk to you about some new ones today. The first one I'll talk about is called a flag. Now, if it's true that the cup and handle is the most powerful, it's also true that the flag pattern is the most prevalent and can be the best pattern for a lot of the different strategies that we teach at TRADEway.com. I mean, listen, we got probably 45 strategies we teach now. When we started out so many years ago, I introduced 21 strategies that we began to teach around the country at most major markets. We taught you guys 21 strategies. And through the years, my students began to develop great trading habits. Many of them, we said, hey, will you come and work with us and be one of our teachers, one of our trainers? And these young people developed another 20 some odd patterns. Of course, I checked them out to make sure that they worked and that they'd been using them for a long period of time and proved that they work. And then we introduced those into our group of strategies. So now it's up to over 40. It's amazing. Now you can't learn all those at once. Don't even try. What's great is to start with what we talked about at the last episode. Those are the basics. Start making money with those first and then expand out into these other amazing, more advanced strategies, and some of which the math is even more in your favor. So you do need to check those out. Here's what I advocate. You cannot master them all at once, but it's great to start getting them all in your brain, right? It's like learning a new language. So I would go out to TRADEway.com and take advantage of step 1, step 2, step 3, step 4, and then move on into the advanced classes, some of which we used to teach on ships and in Hawaii and beautiful places for the advanced students. COVID kind of stopped that, but we're praying about starting that up again soon. But I mean, if you learn these strategies, at least academically, then later you can come back and begin to master the ones you want to use. Why is it important to have a lot of them? Because you need to have several strategies that work in different stages of every market. The bull market has different stages, like the first year is vastly different than the second, third year. And then when you get close to the end, that's different. And you need different strategies that work during these time periods in the life of a bull. And then when it switches to a bear, you need others. So it's important to gain these, but you have to master them sort of one or two or three at a time. But you need to go ahead and get the language in your mind now. So I recommend, if you have the wherewithal to do it, jump in there and grab a big chunk of that education and start getting it in your mind now, because now is a perfect time. I mean, I mentioned it last episode, but it's October of 2022. And we're in a bear market crash, but that's going to be over maybe after midterms. I'm not sure. I won't predict when, but sometime thereafter, it will start the next new bull market. And that first year of the next bull market is the most powerful year that there is. So those that we listed last time, the rolling stocks, the uptrend, the downtrend, and the cup and handles, great for that first year. But now this flag pattern, you're going to see more of these than any of the others. And they can be really great just to do basic stock purchases or even to purchase a call option on an up play. You can even do upside down flags in a down market where it's slanting down. It's a particular form of downtrends that we talked about last time, but it'll make upside down flags and you can buy puts off of those. So flag patterns are so prevalent. They're almost everywhere. And then we're going to talk about stair step patterns. They're very similar. In fact, sometimes a stock will morph from a flag to a stair step and back to a flag. It doesn't really matter because, as I'm going to show you in a minute, the buy point is very similar in both of those. So, it works. Even if it morphs in the middle of your play, it doesn't matter. So let's talk about the flag first. So first, visualize an uptrend. And you can go back and review last episode to get the details on that. So it's a stock that the lows are getting higher over a period of time, usually over a long period of time, maybe as long as 6 months, 9 months, sometimes a whole year. And the bottoms are getting higher. So as you draw that support line, it slants up. That means the tops are getting higher as well. And so you're going to draw a parallel slanted line across the top called the resistance line. And now you have a range that slants up. Now, if you look inside that range, a lot of times that uptrending pattern will be a specific kind that we call flag patterns. And the way they look is it will actually, when it hits the support line, instead of taking like 2 weeks to gradually roll up like a rolling stock, it will shoot straight up in maybe 3 days or even 2 days. It'll go bump, 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 and all of a sudden it's up at the resistance line. And when you look at that, it looks like a straight line almost going up, and that's the flagpole. So picture that. So that creates a thing that looks like a flagpole. Now, it may be slightly slanted up to the right a little bit, but it's basically moving straight up, maybe slanted to the right a little. It looks like a flagpole. And then as the stock starts to hit resistance and move down, instead of going immediately down like it went up, it goes down slowly. So that takes maybe two weeks or a week for it to gradually move back down to the support line, and that creates a thing that looks just like a flag. Then the next thing that'll happen when that thing hits support, it goes up immediately in 1, 2, or 3 days and creates another flagpole. Then it takes 2 weeks or so for the flag to form, where the stock comes down gradually. Can you picture that? So the perfect buy point for this pattern is that what you want to do is you have to have at least one flag already made. And then I like to look back in the history of this stock and see if it's made flag patterns before in the past, because you don't want to wait till it makes the third flag before you say, okay, now I know it's doing flags. Because sometimes, you don't want to go into what we call a late stage base, which would be maybe the 5th or 6th flag. Sometimes the math doesn't work as well. So you want to catch it early. But the way you do that, if it makes one flag, then look back in the history of this same stock and see if it's done flag patterns in the past. Because if it has, and the same 3 influential people that own the most millions of shares of this stock are still in play, it's going to make flags again. So just assume they are. You don't know that they are, but assume that they are still in play. And so when that thing moves up and hits the resistance line again and starts to make the next flag, go back and measure the previous flag. How many days did it take for it to move all the way down from resistance to support? Measure it and assume that the next flag is going to take about the same amount of time. So let's say it took 7 days. Well, as soon as it starts making the next flag, when it's done so by moving down about maybe 4 or 5 days, don't wait for 7 days, because you want to get ready to get in before it happens. So when it's gone about 5 or 6 days down, and normally on the 7th day it makes the next flagpole, which means it just jumps up immediately, you want to go ahead and get in and buy with a call option. Now, this is a little different on this pattern because you can't wait for it to bounce up, because if you do, you'll miss it, because sometimes it goes all the way up in one day. Now, if you're watching a 1-minute chart, you can wait. But if it's gone about the same number of days as the previous flag moving down, and it's moved all the way down close to the support line, it's about to make another flagpole, and you make your money on the flagpole. So you want to jump in before it does that. Once you buy the call option, if it makes a repeatable pattern, which normally these flags do, it will just jump up in 1, 2, or 3 days, and you jump out and make your money. So it'll go all the way from support to resistance in 1 or 2 days, sometimes 3, and you sell. You take your money. And now you wait for it to make the next flag, and it takes about 7 days. Usually takes about the same number of days. It'll move back down. When it gets close to that time period and you're close to that support line, you get ready to buy the call options again, and you jump in, and then boom, boom, boom. 1 or 2 or 3 days later, you make your money again. And you can sometimes do this 3 or 4 times before you need to kind of stop, because once it gets to a late stage base, they don't work as well. So you just stop and wait for it to correct or something, or go look for another stock. So that's how flag patterns work. Now, as far as your stop out, how would you place that? Well, remember, you're still buying the call option or a stock. If you just want to buy the outright stock, you could. You're still buying at support. So you're going to put your stop out just below the support line, right? All right, now let's talk about stair steps. They are very similar to flags. In fact, as far as the buy point and everything, it's so close to the same that it doesn't really matter if it makes 2 flags and then the next thing it does is a stair step. But let me tell you how it looks first, and then we'll talk about specifically how to trade it. A stair step is a little bit different than the flag. It's kind of similar in that the flagpole, the stock hit the support and bounced almost straight up. Now, the stair step even goes straighter than a flag pattern, because sometimes the flagpole slants up to the right a little bit. Usually a stair step just goes up in 1 or 2 days. It just goes all the way from support up and hits the resistance line in 1 or 2 days. It looks like a straight line moving up. And then it may move sideways instead of down. It'll just move sideways for 4 days to 7 days, and then it moves straight up again. And when you make 2 or 3 of these, if you look back at time, it looks just like stair steps. So that's where it got its name. So it works similar in the sense that once it makes one stair step, if you look back in history and it's made stairs before, or even flags, you can assume it's probably going to do it again. And so what you want to do is let the stair part of it, the sideways move, let it go about the same number of days the previous one did. And just before that last day, maybe 2 or 3 days before it. Since it's moving sideways, you can afford to jump in earlier than you can with a flag pattern. And you jump in and you buy that stock right where it is, or the call option. Now, 2 or 3 days later, when it takes the next step up, that's where you make your money. And it does it in 1 day or 2 at the most, and you sell and make your money in 2 days. Who doesn't like that? I like making my money in 2 days better than if it takes 2 weeks, don't you? So the stair steps are powerful. Now, what if it were to slant up instead of going straight up and it morphs into a flag? It doesn't matter. You make the same money, only it took 3 days instead of 1 day. See the difference? So it's okay if it doesn't make the stair step again. It may turn into a flag. Still, you make the same money. If it does, then start playing it like we described the flag pattern. If it remains to do stairs, it's even better because the sideways moves means you can jump in sooner with the call option. Let's say it takes 5 days for it to go sideways and make that stair. And so it's gone 3 days. Go ahead and jump in and buy the call option. 2 days later, it makes the stair step up, and that's where you make your money and you sell. Where do you put your stop out? Well, the same way or very similar way is on the flags. You just let that make its move sideways. When you buy, draw a horizontal line where that sideways part of the step is and put your stop out below that line. Then when it steps up and you make your money, next time you're just going to move your stop out up to the next level. So that's how you do the stair steps. Really good patterns. I'll be honest, there are not near as many stair steps as there are flags, but you'll find them. And when you do find one, you'll get kind of happy because it's really a pretty easy way to predict what might happen. Now, we can never tell the future, but stocks do make patterns. And the reason they're somewhat predictable is because you have a person who has the most shares of that stock, millions of shares, and you got a second and a third person. And if they all see these stair steps coming because they're the ones that made it happen, they will make a lot of money doing it. So they tend to make it repeat. So that's why sometimes you can get into a very repeatable pattern and it's like you can tell the future. Listen, you don't have to tell the future right every time. You can't, right? But what if you get 2 or 3 of these stairs to work and then on the fourth one it doesn't and you stop it out for an 8% loss? And you made 35 to 40% gains on the previous 3, did you make money? Yeah, you'll take that every day, won't you? So that's kind of how the math works, and that's what we want you to learn to do. And you got to keep the rules. You want to have the perfect buy points for those. All right, so now let me talk about the next one. It's called a flat base, and it's kind of boring actually, but it's really prevalent and it's really powerful. So what can happen, well, all the time this happens, is going to make a base. When a stock has moved up for several weeks in an uptrending pattern, and it can be stair steps or it could be flags or it could be just a rolling pattern slanting up, like a uptrend. When it's done that for several weeks, it will stop and take a rest. They just do. And when they take a rest, they either make a cup and handle or they just move sideways. Now, if they move sideways for a couple of weeks or even 3 weeks, that's called a flat base. And those things can be really powerful. So what you want to make sure, to me, they're not as easy to play, but what you really want to make sure if you try to play these is that you do know that the stock has great fundamentals and that has not changed. Still a great company, great leadership, great products, and has a reason to move up. And that hasn't changed. And so it's just taking a rest. And as long as your market tone has not changed and it's still happy and positive and you're in a good bull market, then you can just kind of ride that base. Maybe look back in the past, see if the stock has made flat bases and about how long they last. And boy, it's kind of repeatable. So let's say they took an average of 2 weeks to form. When this thing gets out there about a week and a half, go ahead and buy your call options. And just, it may take 3 or 4 days or 5 days for it to finally take that big move up off that flat base. And when it does, your volume should be higher than the day before and a little bit higher than average. And that shows the big boys jumped in with you, or better yet, you jumped in with them. And that's how you know it's a good play. So the flat bases are really powerful. You don't find as many of them. They're a little harder to do. You have to know a little bit about the fundamentals of the stock and about the market tone to make sure that's going to work for you. But once you know those things, it can be a great pattern for you. And where would the stop out go? Well, right below where the flat base was. So just draw a horizontal line along those bottoms while it's making that flat base and put your stop out right below it, and you're good to go. All right, let's talk about another really powerful one. We call it a W. Some people call it double bottoms, but it makes a formation that looks like a W. Now you have to be a little careful with this because if you're in a rolling stock pattern, they all look like W's. So I only use this if it's in an uptrend or a downtrend. And so picture that you had an uptrend where maybe it's doing stair steps and it's trending up, slanted up line, and all of a sudden it makes a base and it stops and rests and it moves down. And you may think, well, it might make a cup and handle. Well, it might, but if it moves down for, say, maybe a week, and then it abruptly moves back up almost to the point where the down move started, and then it moves abruptly down again for maybe a couple of weeks, and then up again, it looks just like a W. And we say, well, that stands for win, like I'm winning, because that is a pattern that's very bullish. So once it makes the W, what you want to do is when the stock moves up the third time, making that last leg of the W moving up, when it crosses past where the middle hump is on the W, you draw a horizontal line off that middle hump. And when it moves up through that, if it's higher volume than the day before and higher than average, that's a buy point. That's the perfect buy point for a W. Okay, now, if you're a little bit more of a risk taker and you know the fundamentals are great and the market tone is positive, you don't have to wait quite that long. You could wait for that final leg to start moving up and let it move maybe a third of the way up and buy, but it's riskier. So I wouldn't buy with the whole amount. I would sort of pyramid in with maybe half the amount of money you wanted to put into the play, then let it get to that perfect buy point above that middle hump and put the rest in. Does that make sense? So that's the W. It's a really great bullish pattern. And now let's talk about the M's. Okay, so an M stands for murder. It means you're about to get killed if you own that stock. So what else does it mean? It means you have potential for a great put play, which makes money when the market moves down. So let's picture that you have an uptrending stock and it's trended up for maybe half a year, a long time. And boy, it starts to get tired. And now it makes a move down. And then it makes another move up trying to recover. And as soon as it gets to the same price point where it first moved down, it starts to move down again for the second time. Now, sometimes you can call this a double top, right? But when it starts that final move down, it starts to look like an M. And if it moves down past the middle hump of the M, moving down and crosses through a horizontal line that you draw there, and it passes down through there on higher volume than the day before, that is a great place to buy a put. And especially if that volume pops up, it means the big boys are shorting the stock and they're selling the stock and they're going to make that stock move down. You can go down with it with a put option. The thing with puts, I don't like to stay in them as long as I will with calls. I usually stay in them an average of about 3 days, and I'll let it move down and I'll take my profits. But that's the perfect buy point, right when it crosses down through the horizontal line drawn at the bottom of that middle hump on higher volume. You jump in with a put option, stay in maybe 2 or 3 days and take your profits. So that's a great one for a bearish move or a correction. Even bull markets have corrections, where they stop and rest, especially if it's not the first year of the new bull market. If it's the next year and the next year, about every 4 months, they're going to make a correction. So this M pattern is a great play to do with puts when that happens. All right. Now the last one I want to talk about today is called the head and shoulders. And that sounds funny, doesn't it? You say, okay, David's making up another one here. Well, no, this has been around so many years. It's in any book you would ever read about patterns, and it still works. It always has, and it probably always will. And it literally makes a pattern that looks like a left shoulder and then a head, like a person's head, and then a right shoulder, and then it tanks. It is a bearish pattern, maybe the most bearish of all. And so when you look for these, it's a great opportunity for a put play. So these happen after a stock has trended up for an extended period, maybe 6 months, 9 months, and it's tired. And maybe the whole market is correcting at the same time. The market tone is turning negative. The fundamentals are probably still great for this company, but every stock has to rest. So basically, it's making a bit of a base here, but the problem is it's doing it during a correction when the whole market's correcting and moving down for a while. And so it works like this. It'll reach a high point and then it'll take 2 or 3 days and go sideways, and then it'll head down for maybe a week and a half or 2 weeks, and really tanks. Then it moves up and actually goes beyond the left edge of where that thing started tanking in the first place. It goes higher than that, and then it goes sideways for 3 or 4 days and it goes down again. And this forms the part that looks like the head of the person. And if you look back to where it started the first move down, that will look like a shoulder, right? So now once the head is formed, it moves down as low as the bottom of that first shoulder. Then it turns and heads back up and makes it not nearly as high as the head, but it goes up about the same height as the left shoulder, turns, goes sideways 3 or 4 days, and then heads down. Now that's making the right shoulder. And when you see it start to move down on that right shoulder, that's when you need to really get ready with some put options. What I like to do is draw a horizontal line at the bottom of the left shoulder. And when that right shoulder moves down through that line and goes below it on higher volume than the day before and higher than average, that's big boys shorting stocks, selling stocks, and it's going to move that stock further down. So you buy puts right there. Now, in this case, sometimes you can stay in the put a little longer than the average 2 or 3 days, because this is usually a major correction going on, and you can watch the market, you can watch the news, and you might want to stay with that a little longer with those put options. But that is a great play for a bearish market with puts to make money when the market's moving down. Now, I saved the best one for the last because the probability of this thing working is so high. If you go back and you back test this pattern that's called the kiss goodbye, you will see them all over the place, and they work so well. So let me see if I can describe it. This one is a little better if you can see it. And just like with all of these, I highly recommend going out to TRADEway.com, take advantage of our educational programs. And in those beginner programs, we teach these patterns so you can visualize them. You can practice with hundreds of them, and you learn to paper trade, and you learn to small money trade with each of these patterns before you put a large amount into any trade, right? So this one's great. It's easier to see, in the educational material, but I think you can visualize it here. So let's see if we can do it. What happens is you have an uptrending stock. You've got your support and resistance lines slanting up like we described in the last episode. And it runs along just great because you're in a bullish market. Everything's happy on the market tone. The fundamentals are great for this company. And it just keeps moving up for a period of maybe 6 months. I mean, it just goes and goes and goes. And all of a sudden, the whole market, and you're going to get a market alert that's going to tell you, hey, we think this market tone is changing to negative. And sometimes they'll call that a squirrel market so that the real beginners are supposed to just go to cash and stop trading. But if you're a little more advanced and you know the head and shoulders pattern, you don't have to stop. So when you see the market alert saying, hey, this market is cooling off, we're about to have maybe a correction here, that's when you want to think about this pattern. So your particular stock actually hits a resistance line. Maybe it makes a steeper slope there the last week. We call that an exhaustion slope. And then it bounces down. It just starts moving down, okay? So watch for it to move down through the support line, that upward slanting support line. And it moves down below that, and all of a sudden the volume picks up because big boys are selling the stock and shorting the stock and forcing it down. That thing may move down anywhere from 3 to 7 days and turn and head back up. Now, as it starts to move back up, you want to look at your moving average indicators, whichever one that stock used to bounce up off of, which they'll usually pick the 20-day moving average or the 50-day moving average, and it will consistently bounce off of one of those two usually. Figure out which one it was in the past bouncing off of. When that stock moves back up and hits the bottom of that moving average, it will tend to bounce down a little. That's your buy point for a put, and then it tanks. And that's called the kiss goodbye, because what it does is it was an uptrend. All of a sudden it corrects and moves down through support for several days, maybe not more than 3 days, 5 days. Then it turns and tries to recover, and it hits either the bottom of that old support line, but usually it won't quite make it that far. It'll hit the moving average that it used to bounce up off of. It hits the bottom of that thing and it tanks, and that's called the kiss goodbye. So it's a great put play. Normally you'll stay in it a little longer than 3 days like you do with the others. And if you go out to TRADEway.com, there are some other things you can do to make money off of the same pattern, but I don't want to go there today. It's a little more advanced, but that's the basic way to do it is when it does that kiss goodbye, it tries to recover, it hits the bottom of the support line, or more often than that, the bottom of that moving average indicator, and it bounces down. That's your buy point for a put. You might be able to stay in that one longer than 3 days too, because if you're in a correction, it could go down quite a bit. And you know what? When you get these opportunities for put plays in down markets, you normally have the potential to make money faster and make more of it. And that's a good thing, isn't it? So these are great patterns to learn. All right, guys. So remember now, we're in October of 2022. And if you've been saying to yourself, one of these days, I'm going to go out there and grab one of those educational products and I'm going to take advantage of that. Well, now is the perfect time because this correction, this bearish market will be over eventually. And you're going to get the first year of the next bull market. And that is powerful. So you should go out, I think, to TRADEway.com right now, take advantage of the educational programs and get in there and learn these patterns and practice them and do your paper trading and do your small money trading and get ready to put maybe a little bit larger amounts once you've done those things successfully when this next bull market hits. Boy, it can really have the potential to change your family's financial future. So I hope you'll do that. And if you enjoyed this episode, please rate and review it. Let other people know about it. We would really appreciate that. And I think they would too. And I hope you have a great day.